Now, let's bear in mind that bond or debt ratings reflect the relative riskiness of the rated company. Now, this riskiness relates to the probability of default, that is, not repaying the principal and interest when it is due. Now, higher debt ratings result in higher market prices for the bonds and a correspondingly lower effective interest rate for the issuer. So note that when a company has a higher debt rating, for example, AAA, its yield or effective interest rate will be low, and the market price for its bonds will be higher. Now, lower debt ratings would imply that the company has very low credit rating, and because of that, the effective rates or yield associated with that issue will be high or comparatively higher, and the bond price for such companies will be lower. Now, note that financial leverage, which measures debt levels, is one of the ratios that credit rating agencies use to determine debt ratings. Generally, the higher the financial leverage, the lower the bond rating. Now, the lower the financial leverage, that is, the lower the debt level, the higher the bond rating. So what this means is that by reducing financial leverage or debt held by a company can improve its bond rating. Now, business risk factors that could impact bond ratings include the industry characteristics. For example, some industries have higher risks, such as the tech industry, competitive position, marketing, technology, efficiency, regulation, management, and the financial risk, financial characteristics, the financial policy of the company, profitability, the capital structure, amount of debt in relation to equity, cash flow protection, and financial flexibility. We will now turn our attention to shareholders' equity. Recall that shareholders' equity represents ownership interest of shareholders. Now, shareholders' equity is a residual amount, that is what's left over after creditor claims have been subtracted from assets. Contributed capital represents the total investment contributed by shareholders when they purchase stock. Now, note that contributed capital is considered contributed because the company is under no obligation to repay the shareholders. Now, second component of shareholders' equity is earned capital. And under earned capital, we have retained earnings, net income that has been accumulated due to reinvestment in the company. And then we also have accumulated other comprehensive income. And these are income items that were not reported within net income in the income statement. Now, the statement of shareholders' equity discloses transactions that cause changes in shareholders' equity account balances. Some of the transactions are the issue of shares, which increases shareholders' equity. So, for example, for XYZ Corporation, we see that it issued common stock of 215,000, and this increased shareholders' equity. Now, companies may also repurchase shares, and if that happens, shareholders' equity will be reduced. Companies may pay dividends, and the payment of dividends reduces shareholders' equity. Now, the payment of dividends would be under retained earnings, assuming it occurred, and it will result in a reduction of the ending balance of retained earnings because it will be subtracted within the retained earnings column. Now, the balance sheet and statement of shareholders' equity often disclose shares authorized and issued. A corporation's authorized stock is the maximum number of shares it may issue. When the corporation is formed, its charter specifies the authorized amounts and classes of stock. A corporation can later amend its charter to change the amount of authorized shares, but such actions must be approved by the company's shareholders. Now, note that shares that have been sold and issued to stockholders are the company's issued stock. Now, shares outstanding will be the shares remaining after some shares have been repurchased by the company. Now, let's discuss examples of shareholders' equity accounts. Now, contributed capital may include common stock and preferred stock. Common stock and preferred stock may be recorded at par value in the financial statements. Now, the par value represents the minimum value of the stock. That implies if companies sell shares for more than par, what will happen is that the company will report the par value as well as the difference between the market price it sold the shares and the minimum price, which is par. Now, the difference between the shares market price and par value is reported as additional paid-in capital. Now, shares that have been sold and issued can be subsequently reacquired by the corporation, and these shares are called treasury stock. Now, when treasury stock is held, the issued shares will exceed the outstanding shares. Now, many companies repurchase shares in order to offset the dilutive effects of stock options that were granted, for example, to executive officers and other employees. Now, the last account we will discuss is retained earnings. When profit is earned, the company can either pay out a portion of that profit as a dividend or reinvest the earnings in order to grow the company. In fact, many companies title the retained earnings account as reinvested earnings to better reflect the essence of the account. Retained earnings thus represents an implicit investment by the shareholders in the form of foregone dividends. Now, this ends our discussion on the balance sheet and the analysis of assets, liabilities, and shareholders' equity.